Now, let me show you what this has done to valuations of the stock market. And we've had multiple. I've measured over 20 credit purge environments that our country's gone through since the 1870s. Now, of varying magnitudes. Not all of them are equal. And some of them were before we had a central bank, and some of them corresponded after we had a central bank. Remember, the Great Depression of the 1930s happened after the establishment of the Federal Reserve System. One of the macro views, this is kind of the 30,000-foot level of the valuation of the stock market. The stock market in my world is like reading the blood pressure of a patient who's having some chest pains. When the economy is growing and corporate balance sheets are in good shape and there's great in-unit demand and companies are running good profit margins and labor rates are stable and the availability of capital is abundant, you get growing economies. Now, let's take a look at valuation. First of all, I want to point out that the red line, and what we are measuring here, I guess I should talk about what we're measuring here because you probably haven't seen this chart. By the way, if you'll give me an email, I'll get you copies of these charts. My email address is simple. It's john@tradingacademy.com. But we're measuring the market value as a percent of nominal GDP. And then I'm going to show you a chart where we adjust the GDP and the valuation of the stock market for inflation. It has a totally different picture, by the way. But we'll go all the way back to 1924. Now, we're taking the total market cap of the New York Stock Exchange at $15 trillion, adding to it the total GDP measured at a little over 15 trillion nominal dollars. We're adding up the value of the New York Stock Exchange at 13 trillion, and we're adding to it the value of the NASDAQ at 4.5 trillion. And we're doing a little bit of math, dividing one into the other, and we're looking at the valuation of the stock market as a percent of GDP over time, both in bull markets and bear markets. And first of all, let's take a look at the extremes. Now, what do we know about extreme valuations of asset class? We know from history of looking at tons of financial charts, as I've looked at, as I'm sure you have, is that extremes in price are never sustainable. My dad used to tell me the cure for a high price is a high price. And the cure for a low price, son, is a low price. Extremes in price are never sustainable. Now, the red line on valuation, and again, I'm measuring the financial health of our economy by using the stock market, the combined market cap of the stock market, publicly traded companies, as my benchmark, my barometer of economic health or economic decline. Look at the extremes here. The red line is at about 63%. In other words, from 1924 through 2012, and this goes into June of 2012, in taking out all the peaks and taking out all the valleys, the average or the mean valuation is about 63% of GDP, the red line. Does that make sense? Now, note the market in 1924 goes from roughly 28% of GDP right here to a peak of 88% of GDP. That was a huge move. And this was a period that we had looked at earlier of cheap liberal credit. So this was the bubble boom. The availability of cheap liberal credit, the appetite or demand for cheap liberal credit, financed the bubble boom. Bubble booms always lead to credit purge environments under Austrian business theory. And this was the credit purge environment of the 1930s that basically led the equity market to fall from 88% of GDP down to 26% of GDP, and 12,000 banks in America went out of business. Now, why did the 12,000 banks go out of business in America? Why did we purge all the weak banks out of the system? The simple answer is the credit instruments that they had issued to their customers became insolvent. The customers became insolvent, could not pay their debts. Therefore, the banks became insolvent, and they went out of business. It's that simple. So, under our theory that credit is the mother's milk of capitalism, our position here is if you really want to understand what's going on in the equity market, you must keep your finger on the pulse of the global credit market, i.e., the supply and demand for credit. And it's constantly evolving, not only at the retail level, but even at the wholesale level, because there are certain industries or sectors that can readily raise credit. And then there are other sectors that are still credit impaired, like the real estate industry. The real estate industry across the developed world right now is terribly impaired. Now, it may not be that way in your neighborhood or your country, but your neighborhood and your country is not the whole world. Okay? So what drives this tremendous valuation extreme, which is what you and I trade, where markets go to valuation extremes of overbought that are unsustainable, then they collapse into valuation extremes that are oversold, that are unsustainable. Your job and my job is to trade in this environment day to day, or swing trade it in multiple asset classes, but within the macro view of a pretty simple equation in our world, which is the global economy expanding? Is my local economy expanding? Or is the global economy contracting? Therefore, my local economy or the company I'm involved with contracts. It's pretty much that simple. Is the demand for goods and services rising? And if the demand for goods and services are rising at the retail level across the developed world, where is the retail consumer going to get the funding to buy the goods and services from the producers? It's really, in my world, that simple. So let's take a look at this. We see great bubble booms, and then we see bubbles burst. Then we see more bubble booms and bubbles burst. And let's take a look at this one between 1980. This is that great bubble boom. This is probably the greatest bubble in the history of the world. It's over a 1,400% move in the stock market, where we see the market go from, take a look at this, approximately 32% of GDP, 40% of GDP. Take a look at this, all the way up to 180% of GDP. And on a relative basis, look how much more irrational, exuberant things were at an unsustainable valuation in fourth quarter of 2000 versus the previous bubble extreme that we witnessed in 1929 before the Great Depression. Now, ladies and gentlemen, this is measuring the Dow in first quarter of 2000, not only at 180% of GDP, but at 11,700 on the Dow. We subsequently have the collapse from 180% of GDP back down to 95% of GDP in 2002. We get the rally back into 07 at 144% of GDP. We get the tremendous sell-off back into March of 09, coming all the way back to 72% of GDP, almost touching the average or our mean red line, which is 63% of GDP. We get the rally out of March 9th, which is suckering a lot of people into the belief that we're in a new bull market, with the Dow today up around 13,000, the S&P today touching 1,400, the dollar starting to rally against the dollar index, starting to rally against a basket of peers. And, of course, we've seen nothing, and here's where we are today. The market today is trading at about 118% of GDP. Now, let me ask you a question. If I were to connect these higher lows and these lower lows and create a channel here, what does it look like to you where we are headed? Where is this market headed? Because our position is, ladies and gentlemen, here at Online Trading Academy, is that we are in a secular bear market that started in March of 2000, and we are still in it. And this rally out of March of 2009 and all this pain that we have seen is the market continues to decline as a percent of GDP. Now, the GDP in America continues to grow, arguably somewhere between 1 and 1.75%, depending on who you talk to. Now, that's a very good point. Is this chart adjusted for the losing of buying power of the U.S. dollar from 1929? No, what we are doing in this particular chart, we'll take a look at that in a different picture in just a moment. We're looking at the nominal growth of GDP without adjustment for inflation, and we're looking at the nominal value of the stock market without adjusting for inflation. We're looking at a nominal measurement. Now, I'm going to show you a chart in a moment where we measure the Dow Jones Industrial Average in units of gold going back to 1980, where it looks remarkably different because we're using gold as our denominator. Because remember, from 1924 through 1971, the U.S. dollar was convertible into X units of gold.